Something just happened in the silver market that hasn't occurred in over 4 decades. And if you're not paying attention right now, you're about to miss one of the most significant wealth-building opportunities of this generation. I'm talking about a technical formation so massive, so rare, that most traders will only see it once in their entire lifetime. A 45-year cup and handle pattern that's just completed. Let me put that in perspective for you. This pattern started forming when Nixon took us off the gold standard in 1971. It's been building for longer than most people watching this have been alive, and it just triggered. Now, I know what you're thinking. Technical patterns, chart formations, that's all just lines on a screen, right? But here's what you need to understand. When a pattern takes 45 years to form, when it involves trillions of dollars in global capital flows, when it reflects fundamental shifts in monetary policy, industrial demand, and geopolitical power structures, it's not just a pattern anymore. It's a roadmap to where massive amounts of wealth are about to flow. Silver just broke through a resistance level that's held since 1980. Think about that. Ronald Reagan was president. The Soviet Union still existed. The internet hadn't been invented yet. And silver has been trapped below this level for all those years, until now. The breakout happened at $32 per ounce. That might not sound dramatic to you, but to anyone who understands market structure, that number represents something profound. It's the neckline of the largest cup and handle formation ever recorded in any commodity market. And when silver cleared that level with conviction, it sent a signal that institutional money has been waiting decades to see. Let me walk you through what's actually happening here, because the mainstream financial media is completely missing this story. They're focused on stocks, on crypto, on whatever narrative is generating clicks this week. Meanwhile, one of the most significant commodity breakouts in modern history is unfolding in real time. The cup and handle pattern is one of the most reliable bullish formations in technical analysis. It represents a long period of accumulation, where smart money quietly builds positions while the asset consolidates. The cup forms as the price gradually recovers from a major decline. The handle forms as the price pulls back slightly before the final breakout, and when that breakout occurs, especially after decades of formation, the resulting move can be explosive. Here's what makes silver's pattern so extraordinary. The cup portion started in 1980, when silver hit its previous all-time high of $50 per ounce. That spike was driven by the Hunt brothers attempting to corner the silver market. When their scheme collapsed, silver crashed and began a multi-decade decline and consolidation. The bottom of the cup formed around 2001, when silver was trading below $5 per ounce. Since then, we've seen a gradual recovery, with silver climbing back toward that $32 resistance level. The handle formed over the past few years, as silver pulled back from its 2011 high of $48 and consolidated in a tight range. This consolidation was crucial. It allowed the market to digest the previous gains, shake out weak hands, and set the stage for the next major move. And now, with silver breaking decisively above $32, the pattern is complete. But here's where it gets really interesting. The technical target for this cup and handle pattern, based on the depth of the cup, projects silver moving to $80 per ounce or higher. Some analysts are calling for $100. A few are even suggesting $150 based on inflation-adjusted calculations from the 1980 peak. Now, I'm not here to make wild price predictions. What I'm here to tell you is that the setup is unlike anything we've seen in the precious metals market in our lifetimes, and it's being driven by forces far more powerful than just technical patterns on a chart. Let's talk about what's really driving this move. Because understanding the fundamentals behind this breakout is crucial to grasping why this isn't just another false start for silver. First, there's the supply situation. Silver mine production has been essentially flat for years. We're not discovering major new deposits. The easy silver has already been mined. And here's the kicker. About 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. That means silver supply is largely dependent on the economics of those other metals, not on silver's own price. Meanwhile, demand is exploding. Industrial demand for silver has reached record levels. We're talking about solar panels, electric vehicles, 5G infrastructure, medical applications, water purification systems. Silver is the most conductive metal on Earth. It's irreplaceable in many high-tech applications. And as the world electrifies and digitizes, silver demand is only accelerating. The solar industry alone is projected to consume over 200 million ounces of silver annually within the next few years. That's roughly 20% of total global silver production. Electric vehicles use significantly more silver than traditional cars. A single EV can contain up to an ounce of silver in its electrical systems. With EV adoption accelerating globally, that's creating sustained structural demand that didn't exist a decade ago. But here's what really keeps me up at night, in a good way if you're positioned correctly. The above-ground silver inventories are at multi-decade lows. The COMEX warehouses, where silver futures contracts are settled, have seen dramatic drawdowns. Registered silver, the portion available for immediate delivery, has dropped to levels that would take just days to deplete if physical demand surged. We're seeing the same pattern in London, at the LBMA vaults. Physical silver is being withdrawn at rates that suggest major players are taking delivery and moving metal into private storage. This isn't retail investors buying coins. This is institutional scale accumulation. And then there's the investment demand side of the equation. Silver ETFs have seen massive inflows. The largest silver ETF, SLV, has added hundreds of millions of ounces to its holdings. But here's what's fascinating. Even as these ETFs accumulate silver, the price has been relatively contained. Until now. That tells you the breakout we're seeing isn't just technical. It's the market finally recognizing that the physical supply situation is becoming critical. Now, let's talk about something that most people don't understand about the silver market: the paper-to-physical ratio. For every ounce of physical silver that exists, there are estimated to be anywhere from 100 to 250 ounces of paper silver traded in the form of futures contracts, options, and other derivatives. This creates a situation where the price of silver is largely determined by paper trading, not by actual physical supply and demand. But here's the thing about paper markets. They work great until they don't, until someone shows up and demands physical delivery. And when that happens, when the paper market is forced to reconcile with physical reality, prices can move violently. We saw a preview of this during the Reddit-driven silver squeeze attempt. Retail investors coordinated to buy physical silver and silver futures, attempting to force a short squeeze. While that particular effort didn't succeed in breaking the market, it exposed the fragility of the paper-silver system. Premiums on physical silver coins and bars spiked to 30–40% above spot price. Dealers ran out of inventory. Mints couldn't keep up with demand. Imagine what happens when it's not just retail investors, but major institutions, sovereign wealth funds, and central banks all moving into physical silver simultaneously. The paper market would be overwhelmed. And that's exactly the scenario that's becoming increasingly plausible. Let me tell you about what's happening with central banks, because this is where the story gets really compelling. We all know central banks have been accumulating gold at record rates. What's less discussed is their growing interest in silver. Several central banks have begun adding silver to their reserves, recognizing its dual role as both a monetary metal and an industrial commodity. But it's not just central banks, it's sovereign wealth funds, it's pension funds, it's family offices managing generational wealth. These are the smart money players, the ones with access to the best research, the deepest connections, the longest time horizons. And they're moving into precious metals in a way we haven't seen since the 1970s. Why? Because they see what's coming. They understand that the current monetary system is unsustainable. They recognize that decades of money printing, deficit spending, and financial engineering have created distortions that will eventually have to be resolved. And when that resolution comes, hard assets like gold and silver will be the ultimate safe haven. Speaking of the monetary system, let's talk about what's happening with the dollar. The US dollar has been the world's reserve currency since the end of World War II. That status has given the United States enormous advantages, allowing us to run persistent trade deficits and accumulate massive debts without immediate consequences. But that system is being challenged like never before. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with dozens of other countries, are actively working to reduce their dependence on the dollar. They're settling trade in their own currencies. They're building alternative payment systems. They're accumulating gold and silver as alternatives to dollar reserves. This isn't conspiracy theory. This is official policy. China and Russia have been explicit about their desire to move away from dollar dominance, and they're backing up that rhetoric with action. China has been accumulating gold at a pace that suggests they're preparing for a major shift in the global monetary order. Russia has been doing the same, while also becoming one of the world's largest silver producers. Now here's where silver becomes particularly interesting in this context. Gold is the traditional monetary metal, the one central banks hold in their vaults. But silver has always been the people's money, the metal used for everyday transactions throughout history. And in a world where trust in fiat currencies is eroding, Where inflation is eating away at purchasing power, where geopolitical tensions are rising, silver offers something unique. It's affordable enough for ordinary people to accumulate. It's scarce enough to hold value. It's useful enough to have intrinsic demand beyond just monetary purposes. And it's historically undervalued relative to gold, trading at a gold-to-silver ratio that's far above its historical average. That ratio, by the way, is another signal that silver is poised for a major move. Throughout most of history, silver has traded at a ratio of about 15 to 1 relative to gold, meaning it took 15 ounces of silver to buy 1 ounce of gold. In recent decades, that ratio has averaged closer to 60 to 1, and at times it's spiked above 100 to 1. Currently, the ratio is around 80 to 1. That means silver is historically cheap relative to gold, and when these ratios get stretched, they tend to snap back violently. If silver were to return to even a 50 to 1 ratio with gold at current prices, we'd be looking at silver north of $50 per ounce. If it went to the historical average of 15 to 1, we'd be talking about silver at $150 or higher. Now, I want to pause here for a moment, because if you're sitting on retirement savings, if you have $100,000 or more in traditional accounts, this is something you need to be thinking about. I've put together a comprehensive guide on how gold IRAs work, how you can get physical precious metals into your retirement account without triggering tax penalties. It's completely free. Link is in the description. It covers everything you need to know about protecting your retirement savings with hard assets. Worth checking out if this is relevant to your situation. All right, let's get back to where this silver price is headed and why this moment is so critical. I want to tell you a story about 1979 and 1980 because there are eerie parallels to what's happening right now. Back then, inflation was raging, the dollar was weak, geopolitical tensions were high, with the Soviet invasion of Afghanistan and the Iranian hostage crisis. Trust in government and financial institutions was at historic lows, and silver went absolutely parabolic. From $6 in early 1979 to $50 by January 1980. That's more than an 8x move in less than a year. Now that spike was driven partly by the Hunt brothers' manipulation, which ultimately failed. But the underlying conditions, the loss of confidence in fiat currency, the search for hard assets, those were real. Today we have similar conditions, but arguably more extreme. Inflation has been running hot. The dollar's reserve status is being challenged. Geopolitical tensions are escalating on multiple fronts. And the amount of currency that's been created since 2008, and especially since 2020, dwarfs anything that happened in the 1970s. But here's the crucial difference. In 1980, silver's spike was driven by speculation and manipulation. It wasn't sustainable. This time, the move is being driven by fundamental supply and demand dynamics, by structural changes in the global monetary system, by industrial demand that's only going to increase. This isn't a speculative bubble. This is a repricing of a critical commodity that's been suppressed for decades. Let me give you another historical parallel. In 2008, during the financial crisis, silver dropped to below $9 per ounce. By 2011, it had climbed to $48. That's more than a 5x move in less than 3 years. What drove that? The massive monetary stimulus that followed the crisis. Quantitative easing, zero interest rates. The realization that central banks would do whatever it took to prevent a deflationary collapse, even if it meant debasing the currency. Well, guess what? We just went through an even larger monetary expansion. The response to the pandemic involved stimulus measures that made 2008 look modest by comparison. Trillions of dollars created out of thin air. And now we're seeing the consequences. Inflation that's proving far more persistent than central banks predicted. A cost of living crisis that's squeezing the middle class. And a growing recognition that the purchasing power of fiat currency is being systematically destroyed. In that environment, hard assets become essential. And silver, with its unique combination of monetary properties and industrial demand, becomes particularly attractive. Now, let's talk about the mechanics of what happens when silver really starts to move. Because understanding this is crucial to grasping why the potential upside is so significant. Silver is a relatively small market compared to gold or other commodities. The entire above-ground silver inventory is worth maybe $50 billion. That's less than the market cap of many individual tech stocks. It's a rounding error in the global financial system. But that small size is a double-edged sword. It means that when capital starts flowing into silver, even relatively modest amounts can move the price dramatically. If just 1% of global investment capital decided to allocate to physical silver, It would overwhelm the available supply and send prices to levels that would shock most people. And here's the thing. That's not a hypothetical scenario anymore. We're seeing the early stages of that capital flow right now. The breakout above $30 is the signal that institutional money has been waiting for. It confirms that the multi-decade consolidation is over. It validates the bullish thesis. And it's going to attract momentum traders, trend followers, and late-stage investors who've been sitting on the sidelines. This is how bull markets work. They start slowly, with smart money accumulating quietly. Then they break out, attracting more attention. Then they accelerate as FOMO kicks in and everyone wants to participate. And finally, they go parabolic as the last wave of buyers rushes in, afraid of missing out on life-changing gains. Silver is in the early stages of that process right now. The smart money has been accumulating, the breakout has occurred, and the acceleration phase is just beginning. But here's what you need to understand about silver specifically. It's not just going to be a smooth ride higher. Silver is volatile. It's going to have sharp pullbacks. It's going to test your conviction. There will be days when it drops 5% or more, and the financial media will declare the rally over. And then it will turn around and rip 10% higher in a week. That volatility is actually a feature, not a bug. It shakes out weak hands. It creates opportunities for those who understand the bigger picture to add to positions, and it's a reflection of the relatively small size of the market and the intense emotions that precious metals evoke. I want to talk about the short interest in silver, because this is another factor that could fuel an explosive move. The commercial traders, the big banks and institutions that deal in silver futures, have historically held large short positions. They use these shorts to hedge their physical holdings and to profit from silver's tendency to consolidate. But when silver breaks out and starts moving higher, those shorts become a problem. They have to be covered. And covering a short position means buying, which pushes the price higher, which forces more shorts to cover, which creates a feedback loop. This is what's known as a short squeeze, and it can lead to vertical price moves that defy logic. We saw a preview of this potential during the Reddit silver squeeze. Even though that effort didn't succeed in breaking the market, it showed that the short interest exists and that it's vulnerable to a coordinated buying campaign. Now imagine what happens when it's not just retail investors, but major institutions, sovereign wealth funds, and industrial users all competing for limited physical supply. The shorts would be trapped. They'd have to cover at any price. And silver could gap up in ways that would make the 1980 spike look tame by comparison. Now, I want to address something that skeptics always bring up when discussing silver. They say, if silver is such a great investment, why hasn't it performed better over the past decade? Why has it lagged gold? It's a fair question, and the answer reveals why this moment is so significant. Silver has been suppressed, not in a conspiracy theory sense, but in a very real structural sense. The paper silver market, the futures and derivatives that dominate price discovery, has allowed large players to cap silver's upside. They've been able to sell unlimited amounts of paper silver, creating artificial supply that doesn't exist in the physical market. But that game only works as long as people are willing to accept paper claims instead of demanding physical metal. And increasingly, they're not. The premiums on physical silver, the drawdowns in COMEX and LBMA inventories, the growth of silver ETFs that hold actual metal, all of these trends indicate that the market is shifting from paper to physical. And when that shift completes, when the paper market loses its ability to suppress prices, silver is going to reprice violently to reflect actual physical supply and demand. That's what this breakout is signaling. The paper market is losing control. Let me give you some specific numbers to illustrate the supply-demand imbalance. Global silver mine production is around 800 million ounces per year. Industrial demand alone is approaching 600 million ounces. Investment demand, including coins, bars, and ETFs, adds another 200 million ounces. That's already 800 million ounces of demand against 800 million ounces of supply. But wait, there's more. Jewelry demand adds another 200 million ounces. Silverware and other fabrication adds more. And we haven't even talked about the potential for central banks and sovereign wealth funds to start accumulating in size. So where does the extra silver come from? Recycling. Above-ground inventories. And here's the problem. Recycling rates are relatively low for silver because it's used in such small quantities in most applications. It's not economically viable to recover the tiny amount of silver in a solar panel or a circuit board. And above-ground inventories, as we've discussed, are at multi-decade lows and falling. This is a classic setup for a supply squeeze. Demand is exceeding supply. Inventories are depleting. and the price hasn't yet adjusted to reflect this reality. But it will. Markets always find equilibrium eventually, and when silver finds its equilibrium price based on actual physical supply and demand, it's going to be significantly higher than where we are today. Now let's talk about what this means for you, for your portfolio, for your financial future. Because understanding the opportunity is one thing, positioning yourself to benefit from it is another. First, recognize that this is a generational opportunity. The 45-year cup and handle pattern isn't going to form again in your lifetime. The confluence of factors driving silver, the monetary instability, the industrial demand, the supply constraints, the geopolitical shifts, this combination doesn't come around often. Second, understand that timing matters, but not in the way most people think. You don't need to catch the exact bottom. You don't need to time every swing. What you need to do is position yourself before the main move occurs. And based on the technical breakout we're seeing, based on the fundamental drivers we've discussed, that main move is likely just beginning. Third, think about allocation. How much of your portfolio should be in silver? That depends on your individual circumstances, your risk tolerance, your time horizon. But here's what I can tell you. Most financial advisors will tell you to keep 5 to 10% of your portfolio in precious metals as a hedge. Given the current setup, given the potential for silver to significantly outperform, you might want to consider being on the higher end of that range, or even exceeding it if you have the conviction and risk tolerance. Fourth, consider the form in which you hold silver. Physical coins and bars give you direct ownership, no counterparty risk, but they come with storage and security considerations. Silver ETFs offer liquidity and convenience, but you're trusting the fund to actually hold the metal. Silver mining stocks offer leverage to the silver price, but they come with company-specific risks. There's no one right answer. Diversifying across different forms of silver exposure might make sense. And fifth, prepare yourself mentally for the volatility. Silver is going to test you. It's going to have days where it drops sharply, and you question your thesis. It's going to have periods where it consolidates, and you wonder if the move is over. You need to have conviction in the fundamental story, because that's what will allow you to hold through the inevitable pullbacks and participate in the major upside. Let me paint a picture of what the next few years could look like if this thesis plays out. Silver breaks above $35, then $40, then $50. Each level that falls brings more attention, more capital, more momentum. The financial media starts covering it. Mainstream investors who've ignored precious metals for years suddenly want exposure. FOMO kicks in. Industrial users start panicking about supply. They begin forward buying, locking in contracts, building inventories. That creates additional demand pressure. Mining companies ramp up production, but it takes years to bring new mines online. The supply response is slow. Meanwhile, the monetary situation continues to deteriorate. Inflation remains elevated. Central banks are trapped between fighting inflation and supporting the economy. The dollar's reserve status continues to erode. More countries join the de-dollarization movement. In that environment, silver doesn't just go up, it explodes. We're not talking about a 50% gain. We're talking about a multi-bagger move that creates generational wealth for those positioned correctly. And here's the beautiful thing about silver compared to other investments. It's not dependent on a company's earnings. It's not vulnerable to technological disruption. It's not subject to regulatory changes or management decisions. It's a physical commodity with intrinsic value, with thousands of years of history as money, with irreplaceable industrial applications. When you own silver, you own something real, something tangible, something that's existed as a store of value since ancient civilizations. And in a world of digital currencies, of financial engineering, of assets that exist only as entries in a database, that tangibility has value. Now, I want to address one more thing before we wrap up. Some people will say, but what if I'm wrong? What if silver doesn't go up? What if this is just another false breakout? It's a valid concern. No investment is guaranteed. But here's how I think about risk in this situation. What's the downside? Silver drops back to $25, $20. Even if that happens, you're holding a physical asset with intrinsic value, with industrial demand, with monetary properties. You haven't lost everything. You're not holding worthless paper. But what's the upside? Silver goes to $50, $80, $100 or higher. You've potentially doubled, tripled, or even quintupled your investment. The risk-reward ratio is asymmetric. The potential upside far exceeds the potential downside. And that's before we even consider the insurance aspect of precious metals. Silver isn't just an investment. It's a hedge against monetary instability, against inflation, against geopolitical chaos. It's financial insurance. And like any insurance, you hope you never need it, but you're glad you have it when things go wrong. The world is becoming increasingly unstable. The financial system is more fragile than most people realize. The geopolitical order is shifting in ways that could have profound consequences. In that environment, having a portion of your wealth in hard assets isn't just smart investing. It's prudent risk management. So here's what I want you to take away from this. Silver has just flashed a signal that hasn't occurred in over 4 decades. A 45-year cup and handle pattern has completed. The technical breakout has happened. The fundamental drivers are in place. The supply-demand imbalance is real and growing. The monetary backdrop is supportive. The geopolitical trends are favorable. This is the setup. This is the opportunity. This is the moment that people will look back on years from now and say, that's when the silver bull market really began. The question is, will you be positioned to benefit from it? Or will you be one of the people watching from the sidelines, wishing you'd paid attention when the signal flashed? The choice is yours. But understand this, opportunities like this don't come around often. And when they do, they don't wait for everyone to get comfortable. The market moves, with or without you. And by the time it's obvious to everyone that silver is in a major bull market, the easy gains will already be gone.